How can I help you, young man?
I got a $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
Hey!
My next guest ought to have a view. Jeff Nichols, Managing Director, American Precious Metals Advisors. He's also the Senior Economic Advisor to Roslyn Capital, and he runs NicholsOnGold.com. Jeff, good to have you with us on Bloomberg.
Good to be back.
So I'm assuming because of your NicholsOnGold.com, you're still pretty bullish on what's going on with the precious metal gold.
I am. I'm actually quite bullish. I have been for a long time, and I remain so. All the factors that we've spoken about, from Fed policy to central bank policy overseas, the debt situation in this country and Europe, rising demand in India and China, central banks around the world now buying gold, all of these continue, and they're likely to continue for the foreseeable future.
But does the rising price of gold necessarily mean that we're going to have problems in the value of other asset classes? In other words, there's a finite amount of capital, and it's got to go somewhere, and if it goes to gold, it leaves somewhere else.
Well, you know, really, the gold market is a very small market. Compared to capital markets, it's almost insignificant. It gets a lot of attention because it hits us emotionally in certain ways that other assets don't. But
when you make a presentation, let's say to an institutional client, I mean, do you bring a bar of gold or a gold coin? Because but you're right. When people actually touch and feel and lift a bar, a kilo of gold or a gold coin, something happens. You see something in their personality.
Yeah,
almost
there's an
change.
emotional connection to gold, and I can't explain why, but it's been true over the millennia. And gold distinguishes itself over the millennia really as the only asset that has maintained its value over hundreds and hundreds of years. And I think investors look to gold for that reason, as a store of value, as a monetary asset, and as something that is a hedge and diversifier and insurance policy against all sorts of risks.
But yet we've seen gold, as I said, run up to $1,577 an ounce, and you've even written that we've had a little bit of a correction. Is this something that is temporary? Does this last for 2-3 months, or is this something more pronounced?
Well, for better or worse, I think we're still in a long-term bull market, years ahead to run up. I think late this year we could easily see $1,700 an ounce. Next year, perhaps $2,000 an ounce. Beyond that, $3,000 and maybe even higher.
But what gives you the confidence that those are just more than just numbers? I mean, why, let's say, $2,000 an ounce? What is the basis for that particular price point?
It's simply that more and more people around the world are chasing a limited supply of gold. And, in China, for example, 5 or 7 years ago, it was illegal to invest in a bar of gold or a gold coin. Now the government is promoting it as a legitimate form of savings, and China is underinvested. India is underinvested. We're talking about billions of people. As some of those people move into the middle class and become consumers, some of that money is going to go into gold jewelry, some of it's going to go into gold investment, and those are permanent or at least very long-term purchases. These aren't people who are going to sell when it rallies a little bit.
Jeff, what about the risks? Because we know that precious metal investing is different than investing in a stock, for example, where you can look at the quarterly returns. I mean, this is basically the supply and demand, and as you say, it is a very small part of the entire capital allocation of institutional investors, at least right now. And we witnessed, for example, with silver, a huge pullback from the price of silver. How do you manage the risk in these style of investments?
I think you buy for the long term. You buy over time, maybe in a sense dollar cost averaging, and expect that it's going to rise. Gold and silver particularly, even more so silver, tend to be volatile assets in the short run. They have over the past few decades. In the 1970s, which was a great bull market for gold, we saw silver at various points in time pull back 40, 50, even 60% as it was continuing to rise along a upward trend.
You must have had a stomach made of silver in order to withstand that kind of pullback. I mean, how do you maintain the discipline and the poise to stay in the investment, to be long?
Well, you have to be educated, and you have to understand why you're investing. You have to know what the fundamentals are for gold and silver, and be aware that one day things will change, and it may be time to start shedding positions. But I think it's important for many investors to retain, as an insurance policy, some small core holding, maybe 5 or 10% of investable assets in physical metal, as an insurance policy against risks that we can't even imagine.
GADA's Adrian Douglas has done extensive research into the paper manipulation of gold and silver. But the precious metals world changed overnight when Jeffrey Christian from CPM Group made this startling admission at the CFTC hearing in March.
And people will say, well, and you've heard it today, there's not that much physical metal out there. There isn't. But in the physical market, as the market uses that term, there is much more metal than that. There's 100 times what there is.
Now we know based on the testimony of Jeffrey Christian that everything that's true for gold is true for silver, and silver may be even more suppressed than gold.
Precious metals are financial assets, and like currencies and T-bills and T-bonds, they trade in the multiples of 100 times the underlying physical. They trade in the multiples of 100 times the underlying physical.
Adrian Douglas's research leads him to conclude that the actual outstanding paper metals manipulation in gold is 45 to 1, meaning there's 45 ounces of gold sold for every 1 physical ounce in the vault, which multiplies the apparent gold supply 45 times, therefore suppressing price to what we see today.
The supply of gold has been artificially increased by this paper gold to what I think is something like 45 times the actual supply. So that means that when that is exposed and people are asking for gold that isn't there, the potential is that gold's purchasing power will be multiplied by 45 times, in rough terms.
There are 45 times as many ounces sold as there exists in the bullion banks. So what's the price of gold for the bullion banker? $56,000 an ounce, because he sold 45 ounces total, but only 1 physical ounce. He received $56,000 per physical ounce. Now, the U.S. government claims it has 261.5 million ounces of gold left in their reserves. So let's take them at face value and assume the gold isn't encumbered, which Douglas believes it most likely is. But let's say it's not. People say the dollar is backed by nothing, but that's not actually true. It's actually backed by that gold the government claims is in reserves. Now, let's consider the dollar. We've issued $14 trillion against 261.5 million ounces of gold. If you do the division, that comes to $56,000 an ounce, the exact same number as the LBMA selling 45 times as much gold as they've got. Douglas concludes the banks have to sell 45 times more gold than they've got in order to suppress the price of gold and artificially preserve the purchasing power of the dollar.
Typically, gold protects your wealth, but this time it's different. I think what's important for investors to understand is that you will probably be able to buy 45 times more cars, or 45 times more houses, or 45 times more loaves of bread with your gold than you can today.
According to Adrian Douglas, gold should be at $56,000 an ounce, and Jeffrey Christian admits to 100 times the paper as there is to physical.
Precious metals are financial assets. They trade in the multiples of 100 times the underlying physical.
But let's just go with Adrian Douglas's math. Now, Adrian Douglas is making the argument that at gold's current price, it should be multiplied by 45 times to get the true value of gold. Let's go with that and let's apply it to silver. At a closing price of $20.80, if you multiply that number by 45 times, we will get to an unsuppressed silver price of $936 an ounce. However, we know that silver is more likely further suppressed than gold because it's a much smaller market. We can apply silver's all-time high of $50 an ounce, since gold is currently at its all-time high. and we take $50 an ounce times 45, we get $2,250 an ounce for silver. Now remember, there is such a minuscule supply of precious metals in the physical form, backing all of the fiat currencies on the planet, that these numbers, as pie in the sky as they may seem at first blush, if you really think about it and you think about how rare it is for a person to hold physical in their own possession, these numbers start to make a lot of sense.
That is where I see the big payout for the investors. This manipulation has artificially increased the gold supply. When that disappears, you're not going to be protecting your wealth, you're going to be multiplying it by some large factor, whether it's 45 or 20 or 50, I don't know. But it's going to be something of that magnitude.
Got physical? Thanks for watching The Curious Case for $936 an ounce silver.